On other days, the door is unlocked. Maybe there's a class before us.
Oh.
But I don't know what they do because you have to use the card again and again. I don't know how they unlock it.
Right, yeah.
Like, it doesn't seem like there's anything on this side too.
There's another thing I was thinking about is this idea of using a takeover as a way of controlling managers. How easy would it be for a private equity firm to take over Amazon, right? If Amazon is too diversified, right? They're getting into too many different industries. Maybe they're wasting resources on, acquiring Whole Foods. Now they're acquiring like hospitals right now because they want to get into.
No, I didn't know that.
Yeah, so there's
Amazon Healthcare. I think I saw the prescription, right? Like.
Yeah, so they've done. They started doing. They want to do drugs.
Yeah, they have their own pharmacy now.
But they would also like to do like telehealth.
Mm-hmm.
And they bought a company that did telehealth, and they offered it just to Amazon employees and people in the Seattle market nearby. And they did that for like 5 years or something, and it ended up being a failure. And so they scrapped it, but then they bought a bunch of other, just in the past year, they bought a whole bunch of networks of healthcare providers that they want to kind of come up with some streamlined pricing model that will make it kind of reduction of the cost of healthcare. And I think Amazon's one of those where, speaking of an empire, I mean, there is an industry that they are participating in. They're in entertainment, retail, tech, manufacturing. They sell their own products as well as other people's products, right? So they're at what point are they doing too much and they become inefficient and they should be broken apart? But how would a company, how would shareholders, or how would a hostile takeover work at a company like that? I mean, how are you going to get enough shares to be able to really influence management? That's
not possible with such big organizations.
It seems like the only way for it to work is for a company to fall in stock price because of underperformance, and then have a big kind of takeover. But that's a big fall.
Kind of like Netflix. I think something happened with Netflix, right? They lost.
Really?
Well, they lost like 40%.
Yeah, but have they like a takeover?
I don't think so.
Oh,
No.
okay. Yeah, I would be curious to see. And I think that's one of the problems with relying on takeovers as kind of a mechanism to discipline management. In that, well, you can't. These really giant companies now. It's ineffective. It's not feasible. So let's see, which one should we, let's talk more about takeovers with this Stoltz paper. The idea behind this Stoltz paper is that not just about managers owning shares and that being beneficial kind of like you were using the term having skin in the game. If they own shares of the stock, then they will be able to, if the stock price goes up, they benefit. And so they're going to make decisions that are going to be in the benefit of outside shareholders. That's understandable. There's also this idea of voting rights in terms of control over the company. And in the case of a takeover, you know, when I think of a takeover, typically I'm thinking of a private equity firm, either through a leverage buyout or some other mechanism, getting a majority stake in the company, and then using that majority stake to replace the shareholders, replace management. So from a manager's perspective, they don't want that to happen, right?
Mm-hmm.
So if there is an opportunity for a takeover, the manager is going to resist as much as possible, because in any kind of a takeover, you would expect the manager to be fired. Can you think of an example where the manager's not fired in a takeover? I can't. I guess in there are mergers where the CEO of the target ends up being kind of like help kind of.
Yeah, but they don't want that
Retained.
role, and eventually they move out.
Yeah.
Maybe like short term, and then mergers always cause like redundancy.
Yes.
So
So
it's not sustainable. I mean,
right.
they're merging to become more efficient. So
that they're going to get rid of some of
Yeah.
the employees. So that's kind of, I feel like that's part of the crux. I mean, that's a underlying assumption, is that managers hate takeovers. And they want to maintain voting rights so that they can make sure that they, so that a takeover can't push them out. Okay, so this brings us to, the fraction alpha, I should say alpha, of the voting rights controlled by management is an important element of the ownership structure of publicly traded firms. We show that the value of the firm is positively related to alpha for low value firms, for low values of alpha, and negatively rated to alpha. Alpha becomes large. And this becomes more apparent why later, because it discusses some of the I guess you would call it agency costs, but they're costs associated with too many takeovers, and then costs associated with not enough takeovers, right? So you have management, if they're good managers, you don't want to take over. You want the management to stay. But if the manager's not good, then you want more takeovers to get rid of the bad managers. So if alpha is the amount of control that the manager has, and the manager doesn't want to take over, then they'll be able to fend off takeovers that are going to be not beneficial, which would be good if they're a good manager. And they'll be able to fend off value creating takeovers, which is bad if they have too much control. So if alpha is really big. So not only that, but if alpha is really small, if you think about it, so the manager has almost no power, then it'll make it easier for this outsider to come in and buy up half of the shares of the company and kick out the manager. Well, why would that be bad for the outside shareholders if it's easy for the takeover? the argument made here by Stoltz is that it would be bad if it was easy for the takeover, or too easy for the takeover, because that private equity firm that steps in to do the takeover won't have to pay a high enough premium to the shareholders. So the shareholders, if you're a shareholder of the company and the current stock price is $100, and I come in to buy up the majority stake in the company, so I make an offer to buy up half of the company, but I'm gonna buy it at 110 or 120. If you resist, in particular if the manager resists, right, so alpha is a little bit bigger, then it'll make it more challenging. Therefore, I will have to pay not 110, but I'll have to pay 130. And so if I pay 130, that's better for you. Even if the takeover happens, a higher premium is better for you because you're getting that money, right? So those are the two different forces at play, and that's kind of I'm really kind of summarizing the whole paper here. Is that you have if alpha is too big, the manager has too much control, then me as a private equity firm trying to take over the firm, I'm not going to be able to it's going to be hard for me to get enough shares to be able to oust the manager. It's too powerful. He has too many shares. But if the manager has too many shares, then you as the shareholder, if the manager has too little shares, then you as the shareholder will get too small of a premium when I do take over. So you want the alpha, as the shareholder, you want the alpha to be not too small, such that you get a low premium for a takeover and there are too many takeovers. And you don't want it too big where if manager is a lousy person or running the company and they have too much control, so you can't oust the manager, and a hostile takeover won't occur because they can't get enough shares. That's not good for you either. So you want the manager to have, some skin in the game, such that they're a positive force in terms of increasing the premium for a hostile takeover, but it's not too large. Does this make sense?
Mm-hmm.
Okay. So that's kind of the main takeaway, and they're going to dance around it in this paper for a little bit, but. Although managers can change alpha by buying and selling shares, we show that they can also do so through a variety of capital structure changes, through changes in the corporate charter, and so on. So hopefully we'll get to this capital structure piece. Obviously that's a big part of what we're trying to talk about in this first half of the semester. The premium offered in a tender offer is an increasing function of the fraction of voting rights of the target controlled by management, while the probability of a hostile takeover falls with that fraction. And again, this is because, again, if the fraction or the alpha increases, then the manager is going to resist any kind of hostile takeover. So the probability of a hostile takeover will obviously fall. Since alpha plays a crucial role in both the probability and the outcome of a hostile takeover attempt, one expects managers who value control to increase alpha when they learn that their firm has become a more attractive target. This is because the benefits managers derive from a larger alpha increase with the probability of a takeover attempt, where the cost, for instance, the lack of diversification of the portfolio remains the same. Okay, so this is essentially stating what I already said. If managers control a sufficiently large fraction of the votes and always oppose hostile takeover attempts, and that's kind of an exception, right? The value of the outside shares is lowest because no tender offer is ever made. However, if manager controls no votes, a tender offer with a small premium can exceed, even though in general the bidding firm would have been willing to offer a higher premium to acquire control. Hence, if alpha equals 0, an increase in alpha enables the target to get a larger fraction of the benefits from the takeover. Therefore, the value of the firm increases or falls when alpha increases, depending on whether alpha is small or large. So there is a unique value of alpha that maximizes the value of the firm. So you don't want alpha to be too small because of the reasons we were talking about. Not enough takeovers, or the premium that you receive as a shareholder is too small. You don't want it to be too large either, because then the manager is entrenched. Not enough takeovers. So if we want to maximize firm value, we want some alpha that's going to be less than half of the firm, but greater than 0. I know that's big, but that's the idea. That's about as specific as Stoltz is able to get. Okay, so we're gonna fast forward here to okay, so this is kind of starting to lay out the model. We consider the case in which control of the target is guaranteed by possession of a simple majority of the shares. The bidder must therefore acquire half of the shares for the takeover to be successful. To simplify the analysis, we consider only offers of the following kind. The bidder offers to buy exactly half the shares at the total price. So this is going to be half of the value of the firm plus some premium. Okay, some amount. If it was $100 and I offer $110, it's going to be some premium of $10 in that case. Okay, so yeah, Y, where Y is the date to value of the firm if no takeover attempt succeeds, and is common knowledge when the bid is made. So it's kind of like when Elon Musk offers to buy Twitter. He doesn't offer to buy it at the current stock price. He looks back. I think what he did was he looked back to last year when it had peaked. You know, most shares peaked last year. He said, "I'll give you just a little bit more than what your stock price was 6 months ago, and it's down 20% or whatever." So that's a substantial peak in that case for that takeover attempt. Did you hear that he's reviving his offer again?
I read the news that he wants to just, I guess, not get involved in the lawsuit and just go through with it. And he's such fickle-minded.
I know. I'm sure he's going to change his mind again. but that's an example, right? Where he has to buy up in this case, I think he was doing a buyout of all stock to take the company private. So it wasn't necessarily a hostile takeover in where he's only buying half the shares. He's buying all of Y plus P.
Does he really have to go back and look at the high price and give them a premium on top of that? That seems like a lot.
Right. They were really resistant. And so again, that's, as a shareholder, you want there to be the resistance such that you can negotiate up the P. Yeah, it seems excessive. And that's what he was saying later, right? Oh, I'm withdrawing because
that's like something I would do.
Okay, so that's kind of that main idea. Okay, so if we say z of alpha is equal to the fraction of the outside shareholders that must tender for the offer to be successful. And then we can say, in the absence of managerial holdings of shares, the bidder has to persuade half of the outside shareholders to tender to be successful. However, if alpha is positive, a larger fraction, 1/2 of 1 minus alpha, or which is greater than half of the outside shareholders that must tender for the bidder to gain control. To keep the probability of success constant as alpha increases, the bidder must therefore increase the premium with alpha. As alpha increases, the probability of success falls for each premium because the larger fraction of outside shareholders has to tender for the bid to be successful. It immediately follows that an increase in the fraction of alpha, the voting rights controlled by the management, decreases the expected value of the bid to the bidder. So I think it's maybe more complicated the way it's written than what they mean to say. What they mean to say is, if 50% of the shares are by outside shareholders and I hold 50% of the shares. So say I have 49 and 51% is held by outside shareholders. Then outside shareholders, almost all of you have to be willing to accept the tender offer in the takeover. And maybe you're resistant. There only has to be a few people that are resistant to selling.
To increase the price.
To increase the premium. Whereas if I have 0%, my alpha is 0, then even if half of you are resistant and the other half are not, then the tender offer will just go towards the half that are not resistant. So no matter what, if you increase alpha, then it means that a greater percentage of outside shareholders will have to be willing to accept the offer. They can't be resistant to make it a successful tender offer. So the premium is going to therefore increase with the alpha. And as alpha increases, the probability of success falls. Because again, you're relying, the bid or the tender offer is relying on a smaller amount of outside shareholders to be willing to accept it. I think that makes sense. And of course, it's all based on this idea that the alpha, there's no way the manager is going to sell. And that's a that's a strong assumption. Every manager is going to, they care about their wealth, right?
Yeah, they'll be tempted by the.
They'll be tempted by, if the P is large enough, it doesn't matter what alpha is, that manager will sell. Because they care about their wealth too, and we'll get to that. Okay, so it kind of illustrates the same point. But the idea here is, if alpha is 0, then you have the expected marginal gain as a function of the premium. Here on the horizontal axis is the premium. And the vertical axis is the expected marginal cost and gain of the bid. If you increase alpha, then you're going to have to increase the premium. That's essentially what we already showed in result 1. Result 2, from the bidder's perspective, the optimal premium is an increasing function of the fraction alpha of the voting rights of the target controlled by the management. As long as alpha is not as high as a bid is not so high that a bid is a negative net present value project. So again, if you increase P high enough, then
it will end up being negative net.
Yeah, for me, the takeover is no longer of interest. Right? I'm not interested in offering a P that's too high. A higher alpha induces the bidder to offer a higher premium to make the trade-off between the probability of success and the gain associated with a successful bid optimal. Okay, so then we find out, what should the value of the firm be? What should alpha be? Well, it does this function of the value of the firm as a function of alpha. It's this integration. Okay, but the important thing is that you end up with a sum alpha that's greater than 0 and less than half of the firm. Because once you end up with the manager owning over half of the firm, then a takeover is nearly impossible. And that can't be good. So now I want to get to let's see. What are we doing now? As it is risky for management to own shares, alpha is negatively related to the manager's degree of relative risk aversion. Furthermore, alpha, because managers exhibit decreasing absolute risk aversion, alpha is an increasing function of a manager's wealth. So you would expect that, like I said, a wealthy manager. So a manager will, if they have very little wealth, then a large alpha means that they're risking all of their money in the firm. They're under diversified. But if you have a manager that's extremely wealthy and their investment in alpha is a small fraction of their overall wealth, then it's not going to be as big of a deal increasing alpha, because the rest of their wealth can be invested in other companies, other stocks, other ventures. But if all of their wealth is invested in the firm, because of absolute risk aversion, they're extremely under diversified. All of their money is invested in the firm. Increasing alpha is a big strain on them because it's extremely risky. So more importantly, however, alpha is positively related to the benefit that managers get from control. Okay. It follows, therefore, that a decrease in the manager's benefit from control decreases alpha. Again, if there's some utility that they receive from control over the firm, then having an increase, if I have more desire to have control, then I'm going to have a higher desire to increase my alpha. Shareholders can engineer such a decrease by granting management a golden parachute, which suggests that the value of the firm should increase when a golden parachute is introduced to the firm with a large alpha. However, a golden parachute should also be introduced to reduce the value of the bid for a potential bidder, which would decrease the value of the firm irrespective of alpha. Are you familiar with the golden parachute?
I read, we studied, I think it's like when the CEO takes a large compensation and then retires, kind of, or something like that.
Right. Yeah, so it's, and the board kind of arranges it. So it creates an incentive to retire, right? And so if I'm a if I'm a manager and I really love control, well, a golden parachute will be something that will make it so, okay, I'm willing to relinquish my control. Even though I love control, I'm willing to give up the firm because I'm getting $10 million and some stocks.
Mm-hmm.
So this is kind of a mechanism that can be used to kind of incentivize the manager that loves control to kind of change their behavior. So usually when I think of golden parachutes, usually I think of them as being kind of like a bad thing. As a way, again, for a manager to consume Percocets, right? On their way out the door, they're taking money and extracting value from the firm. But in this case, when we think of it in terms of agency costs and them maybe being a bad manager, having a golden parachute might actually increase the value of the firm because if alpha's too large and they have too much control and they're a bad manager,
they're hurting the value of the company.
They're hurting the value of the company. And so you want to get them out. And maybe a hostile takeover can't occur, but at the very least you can give them a bunch of money and ask them to retire. I think that's an interesting kind of angle here. Okay, I wanted to get to leverage because we wanted to talk about capital structure. So here's a little bit about leverage. As more corporate debt is sold, the risk to managers of losing their position through bankruptcy increases, and hence additional corporate debt becomes less advantageous. Furthermore, as the firm issues more debt, the shares become more risky, so the manager bears more risk for a given investment in the firm. As the debt to equity ratio increases, it is likely that at some point a further substitution of debt for equity leads managers to reduce their investment in the firm so that alpha falls. It follows that there are costs to increasing debt and that managers try to balance the marginal costs and benefits of debt when they choose the firm's debt to equity ratio. So if they have too much debt, obviously it's going to be kind of a problem. But if alpha is really small, and you want the alpha to be larger because if you increase the alpha, it's going to make your premium higher in a hostile takeover, then issuing debt instead of issuing equity will make it so that the alpha will grow, or at least not shrink.
Shrink, yeah, not dilute.
You don't want to dilute the alpha because that'll make it so that your P is lower. So that's the benefit of having debt. And that's at the top of the page, it specifically says that for low values of alpha, increases in leverage in general increases the value of the firm. If we hold constant the manager's investment of their own in their own firm, and the way I'm reading this is it's the dollar investment, not the alpha. Okay, so the dollar investment, we hold that constant. And if a change in the debt to equity ratio affects the potential bidder, only because it changes management's control of voting rights. There is a positive debt to equity ratio that maximizes the date one value of the firm, and the probability of a hostile takeover attempt is negatively related to the target's debt to equity ratio, and an unexpected increase in the probability of a hostile takeover attempt increases the target's debt to equity ratio. So really what we're saying is the debt to equity ratio impacts the alpha, and the alpha impacts the probability of a hostile takeover. That's really what we're saying. An increase in the debt to equity ratio can make a takeover less likely because it decreases the bidder's gain from control in addition to the effect on alpha. So the debt to equity ratio impacts alpha, the alpha impacts, so you increase debt instead of increasing equity, then the alpha is larger relatively, which will make it so that it's harder for the takeover. But there's another issue associated with the takeover. It's that if you have a lot of debt, then it complicates the takeover as well because of the debt payments. First, based on the Jensen paper that you presented, the issuance of new debt can be a way for management to bond itself to higher payouts and reduce investment expenditures that raise the value of the firm and make acquisitions of the target less valuable for a potential bidder. You pointed that out. The target's debt may include covenants which restrict the bidder's ability to use these assets in the way it wants to. And an increase in the debt to equity ratio can make a takeover attempt less likely because the bidder may have included in its computation of the gain from the acquisition an increase in the debt of the target. So maybe part of, as the takeover, I want to take over your firm, part of the reason is because once I take over your firm, I'm going to lever you up, which will benefit me. So those are also kind of downsides that will reduce the potential takeover as you increase alpha. As you increase the debt to equity ratio, which will have the impact on alpha, but it has those other effects as well. Yeah, that's really all I wanted to talk about on this paper. You know, an increase in leverage increases the value of the firm for low values of alpha. That's really the big takeaway. In terms of capital structure from this.
Do the managers really own such large fractions of a company? Like,
honestly, I don't think so. I mean, okay, so you take someone like Zuckerberg. When they first went public, he might have owned like 30 to 40% of the company at that point. when they went public. Or maybe it wasn't quite that much. But owning over half of the company, I don't know if I don't know how common that is. Certainly not for really big market cap firms. Because obviously, if you have so few outside shareholders, it's hard for you to get a market cap so high.
I think I was also reading that like they're able to sell the shares, but they hold the voting rights somehow. I mean, the way it's structured, they like to hold on to the voting rights.
Yeah.
And they have like veto powers and like some
right.
increased powers.
So yeah, so that is one approach, is to have different classes of shares.
Yeah.
With different voting rights.
Yeah.
Right. So you can a firm can do that.
Yeah, and they keep the ones with the high voting rights, and they only sell, you know.
A separate class
Yeah.
of shares.
Yeah. And the voting rights are essentially part of alpha, I think. You know, it's not just the dollar value, it's also like
Right.
how much influence they have.
Right, right. But I think that's a really good distinction to make, is that as a manager, you can make that decision about if you are going to issue outside additional, you need equity, and you're going to issue new stock. Maybe issue new stock that has no voting rights.
Yeah.
That would alleviate part of this problem.
The market will take that into account, and it will give them a lower price for that.
Yeah. Anything else you were thinking about that?
No.
So this Heaton paper, I mean it's in financial management. I mean, not quite top. Not necessarily a top journal, but I think it draws on some of this theory that we're talking about, Jensen and Myers and Magaluf in particular. There was Myers and Magaluf what we did 2 weeks ago?
2 weeks or 3 weeks ago, maybe.
Or 3 weeks, okay. So it's going to talk about, the pecking order and this agency cost associated with free cash flow. And it's going to create a model that's going to combine these two. It's going to say, hey, look, I can explain Myers and Magaluf, and I can explain the free cash flow agency problem with one model. And it's about managerial optimism. And this I think is clever. So when we think of managerial optimism, optimism is a very nice way of putting it. What he's really saying is this self-attribution bias, this overconfidence, or kind of arrogance of managers. And this arrogance not only impacts the way you view the value of the firm, but it also impacts the way you value the success of future projects. So which is problematic, right? Because if you value the firm too high, then you think that no one's willing to pay you enough money when you issue new stock. So you say, hey, I'm not going to issue new stock because they're not willing to pay me enough for it. And then you say, well, I don't want to issue debt because they're charging me too much interest. I'm not as risky.
I deserve lower, yeah.
They think I'm risky, but I'm not. I'm super high quality, right? So this is the managerial optimism in play. So when it comes to external financing, the optimistic manager, or I should say arrogant manager, thinks they're too good for external financing. So you have free cash flow, and that will allow them to invest in projects that they would otherwise have to pass up on. Positive net present value projects that they otherwise would have had to pass up on because they were too proud to go to the outside market to externally finance the project. But if you have enough slack, right, enough free cash flow, you can finance those projects, positive net present value projects, without external financing. But there's also a problem. If I have too much slack, too much free cash flow, then I'm going to see all these other projects, and I'm going to say they're going to be extremely successful. I'm going to overestimate the future cash flows generated by those projects. And in reality, you as a shareholder are going to say, wait a second, those are negative net present value projects. And me as the manager, arrogant manager, I say, no, I want to invest in those because they're positive net present value projects, when they're not. And so I throw a bunch of the free cash flow at those negative net present value projects. So there are two problems. One is a problem associated with me not willing to invest in positive net present value projects because I think external financing is too costly, because I think the value of the firm is too high. Or I think outsiders don't view it high enough. So I underinvest. But then there's the over-investing problem, because I see these projects and I think they're positive net present value and they're not. Have you heard of MoviePass?
No.
So MoviePass, I was just listening to this podcast about MoviePass a few days ago, and it just blew my mind. Because I remember hearing about MoviePass, but I didn't join it. MoviePass was this company that, it was like a club program. If you join, you pay $10 a month. Actually, I think when this new CEO took over, when you joined MoviePass, you had to pay something like $40 a month. And then you could go to as many movies as you wanted for free. So MoviePass would pay for your movies. You just had to make this $40 payment every month, and you kind of join the club, and you can go to as many. So if you go to like 4 movies, you break even. So if you go to at least, one a weekend, it might be worth it, or more than one a weekend. Well, this new CEO took over. He was a former Netflix executive. And Netflix was in the business of they've been overspending on production just to attract subscribers.
Mm-hmm.
And now that model is kind of not succeeding because they've kind of capped out and started to lose subscribers. So this CEO takes over and says, I'm going to drop it from $40 a month to $10 a month. So if you go to 1 movie a month, it's paying for your subscription. So after he released it, this change from $40 to $10 a month, they increased their subscribers by, it was like 200,000 new subscribers in 2 days. And within a month or two, MoviePass had, it was millions of subscribers. And MoviePass was losing hundreds of millions of dollars on it.
Because they have to pay the theaters, right?
They have to pay the theaters the
Mm-hmm.
retail price. And so they're losing money because all of these people, you're paying for one ticket, but you can go as many times as you want during the month. And so, shockingly, the CEO didn't anticipate this. And they ended up losing tons of money. And they were trying to get external financing to stay afloat. The idea was, if it's low enough, kind of like Netflix had in mind, if it's low enough, then you'll get tons of subscribers. And once you get tons of subscribers, then you can change the whole model of how the movie-going experience occurs, because you would have negotiating power. So if the CEO's mind was, well, then I can go to the movie theater and say, I won't pay retail. I want cheaper tickets. I'm not going to pay the full price because I have millions of people that are coming to your theater, more than you used to have. And if they buy popcorn, I want to cut the price, the popcorn. And I'm going to sell their data. And if there's a movie you want them to see, you can pay me and I will advertise it to them. So there's these different streams of revenue, potential streams of revenue, that this particular manager, this executive had in mind to essentially make a profit. But in reality, this whole idea was a negative net present value project. And for some reason, this manager thought he was so smart that he could attract a whole bunch of new subscribers to this model. But in reality, the whole notion was a negative net present value project. The company went out of business, and it ended up and it's been sued for completely mismanaging the company. This not only the company was sued, but also the CEO had been sued because at one point there was a really big movie that was coming out, and they were about to go out of business, and he locked everyone out of their accounts, so they couldn't go see this movie. It was a Tom Cruise Mission Impossible movie that was coming out. This was like 10 years ago. And so the government is suing him for essentially cheating on its customers.
Not following through on the contract.
Yeah, exactly. So this is an idea of investing in a negative net present value project that it shouldn't have invested in. Sorry, that was a long-winded one. Okay, so managers are optimistic when they systematically overestimate the probability of good firm performance and underestimate the probability of bad performance. This assumption finds support in a larger psychological literature. For example, people are more optimistic about outcomes that they believe they can control. Managers underplay inherent uncertainty, believing that they have large amounts of control over the firm's performance. People are more optimistic about outcomes in which they are highly committed. The most obvious arbitrage of managerial irrationality, the corporate takeover, incurs high transaction costs. And I guess using this term irrationality is maybe a little taboo, and maybe that's why it didn't get published in a higher journal. But is it irrational to be confident? That's a good question. I think that's a reasonable question to ask. The learning objection, irrational agents will learn from their experience to become rational in the future after they've learned that they were irrational, is also weak. Important corporate finance decisions about capital structure and investment policy are more infrequent than trading decisions. Learning from experience is less likely in such circumstances. And I think you run out of times. I mean, like this example with MoviePass, it was a one-shot go. When that company went out of business, he did not get another chance at being CEO. Some internal incentive mechanisms may select against rational managers in favor of irrational managers. Irrational managers, for example, may take larger risks that lower their true expected utility, although not their perceived expected utility, yet increase the probability that some irrational managers win the tournament. And that's kind of what I was suggesting, that, you know, if you are extremely confident, you're more likely to become a manager. It's only those that are really optimistic. You're not gonna hire a CEO that says, well, the future of this company is bleak. No, you're gonna hire the manager that says that the future is bright. Okay. The asymmetric information approach, typified by Myers and Magillif, in that the free cash flow is beneficial because managers loyal to existing shareholders are assumed to have information on the market does not have. The main claim is that managers will sometimes decline new and positive net present value investment opportunities when taking them requires issuance of undervalued securities to the under-informed capital markets. The financial slack provided by large amounts of free cash flow prevents the socially and privately undesirable outcome. Then when we go back to Jensen, the paper you presented, leverage increasing transactions that bond the firm to pay out free cash flow increases shareholder value and mitigates the conflict of interest between shareholders and managers. The managerial optimism assumption delivers both of these results in a single framework, implying an underinvestment, overinvestment trade-off from managerial optimism without invoking asymmetric information or rational agency costs. Because again, this is all based on irrationality. Managerial optimism leads managers to believe that an efficient capital market undervalues their firm's risky securities. And there's this preference for internal funds. Optimistic managers dependent on external financing sometimes decline positive net present value projects, believing that the cost of the external financing is simply too high. Free cash flow can therefore be valuable when the firm has a positive net present value project that optimistic managers would otherwise decline because of incorrectly perceived costs of external financing. Free cash flow can prevent social loss from this underinvestment. And I think that if I think the company is extremely undervalued by the market, then I'm not going to be willing to issue equity to finance a project. And I might not be willing to issue debt either. But that'll lead to underinvestment because of my pride. But you can also see the other side where there's overinvestment, not just underinvestment. Managerial optimism causes systematically upward biased cash flow forecasts and causes managers to overvalue the firm's investment opportunities. Managers without free cash flow may decline taking a negative net present value project to they perceive to be a positive net present value project because the cost of external financing seems too high. In this situation, free cash flow is harmful. Free cash flow alleviates the need to obtain external finance and makes it easier to take negative net present value projects mistakenly perceived to be positive net present value projects. So this is really nice in that it ties in the Jensen 1986 and the Myers and Majelev results. Myers and Majelev say, hey, you got the pecking order that you want internal financing first, external financing last. Well, if you're in this irrational model, that's the case as well. Internal financing, external financing last. When it comes to Jensen says, right, internal financing is problematic because it has all these agency costs. Well, in this model, it says internal financing is problematic, not because of the agency costs, but because of this irrational behavior. So it's similar. It's similar, but it's I guess Jensen is assuming that they're rational when they're empire building. But this model is saying, hey, they're not rational. They actually view these projects as positive net present value projects when they're not. Optimistic managers want to undertake more projects. The more optimistic the manager, the less likely it is to finance a project externally. The better are the firm's projects, the more costly this underinvestment is to shareholders. For firms with poor investment opportunities, reliance on the external capital markets is beneficial. This implies a shareholder preference for cash flow retention at firms with both high optimism and good investment opportunities, and a shareholder preference for cash flow payouts at firms with both high optimism and bad investment opportunities. So it really is this balance, right? If there's this benefit to cash flow, free cash flow, but there's this disincentive or this problem associated with the free cash flow as well. Okay, so just this model is similar to Stoltz in that it's a two-period model. Asymmetric information theories assume that managers have information that the capital markets do not have. When we think about empire building, this assumes that it is impossible to write a contract that fully controls managers' incentives. There are a few assumptions. Information about the firm's cash flows and investment opportunities is simultaneously available to the capital markets and the manager. Managers take all the projects that they believe have positive net present value projects, even though they might be wrong. And then security prices always reflect discounted expected future cash flows under the true probability distribution. So it's important here that the markets are rational, even though the manager is not. And you might say that's not fair. To further simplify the model, I make the following assumptions about the risk preferences, interest rates, taxes, and costs of financial stress. The capital market is risk neutral and the discount rate is 0. There's no taxes, no cost of financial distress. The initial project requires an investment of K at time period 0. Must finance K by selling some mix of securities in the capital market. So what you have is two outcomes from the project. One is a good cash flow, one is a bad cash flow. So here is in time period 2, you have this good cash flow or bad cash flow from the project. Obviously, the good cash flow is going to be larger than the bad cash flow. And then you have some probabilities that that you're going to have an outcome of good and an outcome of bad. And there's only those two options, so the probability has to equal 1. Add up. Bless you. Now, those are the true probabilities. They're not the manager's probabilities. The manager's probabilities are going to be inaccurate, and that's down here. The manager's probability is going to be greater than the true probability because the manager thinks that everything's going to be good about the project. But the manager also underweights the potential for a bad outcome. What you also have is a situation where you have a new investment opportunity in time period 1. So this was all about the cash flow and the good and the bad states. And then you have this investment that will have a high payoff or a low payoff, where obviously the return on the high payoff is higher than the return on the low payoff. So, and so there's going to be some probability, true probability of the high or the low payoff. Again, the M subscript denotes the manager's perception. So what's the result? The result is the prices of risky securities reflect the capital markets probability of good versus bad states of the world, because optimistic managers systematically attach higher probabilities to good outcomes than the capital markets. Optimistic managers with the capital markets undervalue the firm's risky securities. That was what we were talking about. This induces a pecking order capital structure preference, where managers attempt to minimize costs of external finance by minimizing the amount of risky securities issued. Safe securities are less sensitive to probabilistic beliefs, and thus are less undervalued by the capital markets. Whenever the manager can use internal cash or risk-free debt, both of which are insensitive to probabilistic beliefs, they strictly prefer this to issuing any risky security. So here, what we have is the fraction of the firm sold to raise capital K times the total value of the firm perceived by the manager divided by the capital K. That needs to be greater than 1. And I should say the firm can be financed if and only if the true cash flow generated by the project is greater than the capital that it costs to invest in the project. The firm can be financed only if and only if the expected value is greater than the investment. If the amount generated by the amount cash flow generated in the bad state of the world is greater than the cost of the project, then the manager can issue risk-free debts sufficient to finance the firm, since the debt is repaid in either state of the world. The manager correctly perceives the cost of the financing to be K divided by K, which equals 1. To finance the firm entirely by equity requires selling a fraction alpha, which is K divided by the capital that it costs to invest, divided by the true value of cash flow in time period 2. So the cash flow that the manager thinks is going to be generated in time period 2 is greater than the cash flow that the true cash flow is going to be generated in time period 2. All this leads us to see that the alpha, or the amount of equity that the manager thinks they'll need, is less than the amount of equity that you actually need. And that's what you would expect, because the manager thinks that the equity be sold at a higher price. And so the number of shares that need to be sold should be lower. But the manager's wrong, because they're over optimistic. And since the manager can issue risk-free debt, he will not issue equity. Why? Again, because he thinks that the amount of equity that should be issued is less than the amount that is needed, and so they think it's too expensive, shouldn't do it, shouldn't issue equity. Then this further demonstrates this concept here of wanting to avoid issuing equity. The manager will always strictly prefer an issue of risk-free debt to any issue that includes equity. Considering the case where the cash flow in time period 1 plus the bad cash flow in time period 2 is less than the investment capital. That is, where the manager must issue some risky security to finance a project. It also follows that the manager will issue security with the largest component of risk-free debt, equivalent to the preference for risky debt over equity. So that's all on the side of the investment side of things, right? The perceptions of external financing and investing. Now, if we think about the cash flows, by definition, the manager thinks the cash flows are going to be higher than what they really are. And because the good cash in the good state of the world, the cash flows are greater than the bad state of the world, then managers are optimistic that average realized cash flows fall short of the managerial forecast. The perception that risky securities are undervalued can lead to social losses that are alleviated by sufficient amount of free cash flow. Consider what happens when the managers face a new investment opportunity. If the managers have internal cash flow of Y, then it is clear that they will use this before raising external funds. Denote and any necessary external funds by E, and let C sub M of E denote the additional cost of external funds perceived by the manager. That is the perceived wedge between the cost of internal funds and the cost of external funds. The manager never perceives a gain from selling securities. Faced with a new project that requires an investment of I, where I is greater than the cash flow of time period 1, the manager's decision would be to invest if the expected return on the investment minus the investment, minus this cost perceived by the manager, is greater than 0. And won't invest if the manager perceives the return to be less than this investment and the cost of external financing. So when the true return minus the investment is greater than 0, and the return that the manager thinks there will be minus the investment minus the cost perceived by the manager is less than 0, the manager passes up on positive net present value projects because he believes the cost of external financing is too high, despite the fact that he believes that the project has a positive net present value. Free cash flow alleviates this problem by eliminating the perceived cost of external funds from the decision. Optimistic managers sometimes want to take negative net present value projects that they believe are positive net present value projects.
Professor, what are social losses? What do they mean by social losses?
Social losses. Oh, here.
Maybe like a reputational loss or something.
I believe that's referring to the shareholders not having the gains that they would otherwise have received if that free cash flow wasn't wasted. That's a good question. The manager will want to take too many projects from the ranking. The true expected cash flow for a given new project is the expected return, the true expected return, times this weighted average of the return from the high investment project and the low, not high investment, but the high return investment and the low return investment. The manager's perceived expected cash flow would be somewhat different because the probabilities are different. Optimistic managers believe that the negative net present value projects are positive net present value projects when the expected return of the manager is greater than I, which is greater than the true. So there's this window between what the manager expects from the project and what the true return on the project. That gap between those two is where you're going to have those investments that are going to be problematic. Those are the negative net present value projects that the manager invests in. Because if the manager's optimistic, but I is less than E sub T R, then there's no harm done. They're investing in projects. They might think they're really high positive net present value projects, but they're just
a little bit
high, right?
That's a good call.
Positive, and that's okay. It's the lens where yeah, and certainly as a manager, there's also the situation where it's a really negative net present value project, but to me as the optimistic manager, I might say, oh, it's just barely not positive. But I'm still gonna not invest, which is the correct decision. I just had the miscalculation. It's only in that window where the difference those projects that I perceive to be positive, but in reality they're not. Those are the ones that you're trying to avoid. It's this limited set of bad decisions that will be made by optimistic managers when the investment cost I exceeds the high cash flow state RH. Then the optimistic managers never take the project. There are projects that are bad enough that even the most optimistic managers will not take them, because optimism about the probability of good state can never overcome the fact that the good state is never good enough to overcome the investment cost of the project. Okay? So nevertheless, the range of negative net present value projects that the optimistic manager will accept can be quite large. So whenever you're in that space where the manager thinks it's a good project, but in reality it's not, the optimistic manager wants to take the negative net present value project that he perceives to have a positive net present value. He will not use outside financing. He will not use outside financing when it is unavailable, because the firm will generate insufficient cash flows to provide the necessary return to the security. Thus, the market will refuse to buy the newly issued securities. Or it will not use outside financing when the perceived negative net present value of that financing outweighs the perceived positive net present value of the project. That is, that this cost perceived by the manager is greater than the expected return by the manager minus this investment. So that what you would say is the net gain is not as high as the perceived cost by the manager. It follows that the free cash flow in the amount I will allow the manager to accept a project. He will accept it, and the value of the firm will fall. In this case, access to free cash flow is harmful, forcing the optimistic manager to the capital market might not prevent all bad investments, but it will prevent those that are in that space where the expected return minus the investment minus the perception of the cost of outside financing is less than zero. Without free cash flow, the misperceived cost of external financing actually prevents some value destruction by the optimistic managers. So this is where it just really gets to that kind of trade-off here. That optimistic managers believe that capital markets undervalue their firm's risky securities, may pass up on positive net present value projects that must be financed externally. That's why you would want internal cash flow or free cash flow. But the optimistic managers overvalue their own corporate projects and may wish to invest in negative net present value projects even when they are loyal to shareholders. So this leads to an underinvestment or overinvestment trade-off related to this free cash flow. And Heaton is proud to say this is without invoking asymmetric information or rational agency costs, based on Jensen and Meckling, or not Jensen and Meckling, the Jensen 86 or the Myers and Magillov.
He's saying it's his own new theory.
Yeah, it's creative, right? This idea. I think it's a nice blend between the two. It's just another way of viewing why managers might act the way they do. Do you think it's consistent with those other theories?
Maybe consistent in the results, but not the way he approaches them, right?
Right.
He's saying it's a behavioral approach that he adopts.
It seems like, and I feel like this every time any of these papers that I read, I think, oh, this makes sense, right? This is what they're explaining is behavior that makes sense to me, and the incentives that they explain in their models are incentives that I can see managers and the firm reacting to. But then I read another paper and then I see these other incentives and this other behavior and this interaction with whether it be capital structure or ownership within the firm or as we'll see in some future papers, dividend policy. That explains something the other paper didn't explain. And they all kind of stack on top of each other, these different ways of viewing the decision to issue equity, issue debt, this particular capital structure problem. It has these different ways of viewing it that all seem to make sense, but they don't all go together. This is at least one way of saying, hey, let's take two of these ideas, very popular ideas, the asymmetric information and the agency costs, and come up with something that'll explain that behavior without those theories. It's interesting. I certainly think that managers are overconfident at times, and we can think of examples, right? But asymmetric information, it's hard to argue against that. That managers know more than shareholders, and that new shareholders know more than old shareholders know more than new shareholders. And the manager has some loyalty to the old shareholders, right? That's the Myers and Maslov argument, right? And agency costs, right? What you talked about in the Jensen paper, agency costs are real. That principal-agent interaction and trying to align the interests of a manager with those of shareholders, that's a real problem, an issue. So to shrug them off as if they're not, that we're really just dealing with irrationality here. And maybe that's not what the author is doing, but it kind of feels like that a little bit. I don't think that's fair. And then if you go all the way back to like the Miller and Modigliani and Miller, that what we're dealing with is not just agency costs, asymmetric information, and irrationality. We're dealing with incentives associated with the tax benefits of capital structure. And those are important to think about, right? So they all, I don't think one model is better than the rest. I think they all explain something. And it's up to you to come up with the super model that puts everything in it. everything explains all behavior. Okay, so next week, we'll do the Graham and Harvey. This is a survey, I believe. Let's see. Graham and Harvey. Yeah, it's a survey of almost 400 CFOs. And it kind of gives us a feel, this is 20 years ago, a feel for what they think is useful when it comes to corporate finance. And we can compare that to what we think is most important in theory. And so that's really interesting, because obviously we see what is taught at the undergraduate level and the graduate level when it comes to how corporate finance decision making should be made. How do CFOs actually make decisions? We'll do the Baker and Wergler 2002 paper, which is awesome. This one's about the market timing. That everything can be explained with all financial decision making and capital structure is just this movement along, depending on whether or not you're, as a manager, if I know that my stock is overvalued, then I issue stock. If it's undervalued, I issue debt. And that's all I do. I don't actually have a target capital structure. I don't care about target capital structure. All I do is try to take advantage of new shareholders. That's going to be a fun one. And then the Lochran and Ritter. So this is about IPOs in particular, right? Why do we issue so much equity when we issue equity, we're leaving money on the table due to underpricing? And that's going to be a big part of the papers here towards the end. Towards the end, we're going to talk a little bit more about this this underpricing issue. But we're going to talk about it a little bit here in the Lochran and Ritter 2002. So I guess these are all three of them are empirical papers. Is this yeah? So that's a little bit of a break from the theory and more some empirical findings. And then we'll have one more week and then the midterm. What do you think?
Exciting papers coming up.
Yeah. But going into the midterm, right? So we have 2 more weeks of papers going into the midterm. You should have a good. Your thoughts should be around this idea of capital structure, like how Miller, Myers and Majlov, Jensen and Meckling, Myers, Jensen, Stoltz, Heath, all these, Baker and Wergler, they all give different explanations for capital structure. Is there an optimal? Is there not? Is capital structure independent of investment? Is capital structure fully dependent on corporate tax rates? Well, these are the types of questions you should be thinking. That's the types of questions that I'll be thinking about when it comes to the midterm. But hopefully all of these put together will kind of inspire kind of a fuller view of what it means to issue debt and what it means to issue equity and that decision that is being made. And obviously every CEO has not read these papers, so they're not necessarily doing it based on theory, but their behavior, hopefully we're able to model with theory, if that makes sense.
Mm-hmm.
Any questions?
Which people are like certain that there is an optimal capital structure? Like I know you said Baker and Wergler are definitely saying, you know, that there isn't an optimal one.
Yeah, Baker and Wergler say no. Let's see.
I think one of the papers we looked at.
Miller says no. Mediglione and Miller say no. The Myers papers say that there's a pecking order, not necessarily like an optimal capital structure, but you should be just using internal financing.
So it doesn't matter where it leads you to, like where the capital structure goes. They just say use the money this way.
Yeah, was that one of them was saying that, right? Jensen and Meckling definitely says there's an optimal, right?
Okay.
You have the agency cost of debt and the agency cost of equity. You try to balance between the two.
Okay.
Stoltz says there's an optimal.
I think the Myers 1977 one also says
that there's an optimum.
Right? Like, was that the one where we were talking about the graph with the kink in it?
Oh, the kink. That was Graham.
Graham.
Yeah, Graham was kink, and that was saying that there was an optimum. You're right. Let's see. Oh, this was the one about that you can think of as options. That investment opportunities for like options. Yeah, this one had as you increased the amount of debt, you were actually reducing the value of the firm. Well, but remember in the appendix, there was kind of an optimal capital structure here. We increased it because of when you include the tax deductibility of debt. There was some optimal firm value, so optimal level of debt that maximizes firm value. This one had an optimum too. So yeah, the Myers ones say optimum. There is an optimum. Where's the? So both of those say optimum. Jensen says optimum. Miller says no. Graham says yes. Stoltz says yes. So Baker and Murdoch say no. So yeah, it's any other thoughts you have about this so far? Okay, we'll end there. I expect summaries, 2-page summaries from each of these 3 papers, and I still need summaries from these ones from the Jensen, Meckling, Myers, and the Myers paper.